Hello YouTube, welcome to Mindful Investing. My name is Sean, and in this video I want to talk about retirement accounts. There are a lot of confusions about the different accounts, and hopefully this video will answer some of it. Please comment down below if you have any other questions, if I didn't address some of it. Alright, let's get started. So first thing is IRA. So what is IRA and what are the options? So IRA is the individual retirement accounts, and there are two options available: traditional IRA and the Roth IRA. Traditional IRA mostly is tax deductible, meaning you don't have to pay the federal income taxes. And other thing is you have to pay taxes when you retire. I think for the IRAs, the retirement age is 59 and a half years old. So after that, you can withdraw the money and pay taxes and withdraw the money. Compared to the traditional IRA, the Roth IRA is a little bit different. It is after tax money, meaning you have to contribute. You can contribute after tax money, and whenever the account grows and you are retiring, you can withdraw the money tax free. That's really good. One of the other benefits is you can withdraw the contribution anytime. So that is one of the good benefits of the Roth IRA. So if you are in the low tax bracket, usually individuals who are younger, they are usually in the low tax brackets. So it is really beneficial for young people to open the Roth IRA. So what are the contribution limit per year? So 6,000 as of 2019 per individual, and 12,000 if you have a family with a spouse, right? Each of you and your spouse can contribute 6,000 each, so that totals to 12,000. One of the good benefits of the IRAs is you can use multiple investment instruments: stocks, bonds, ETFs, mutual funds. So if you know some of the investments that you like, you can choose. So this is really useful if you know how to invest, and you know how to choose companies that you want to invest. And what are the limitations? Limitations are usually none in traditional IRAs, unless your employer provides retirement accounts. I think there's some limitations, but if your income limit is 196,000 for family and 124,000 as single, I think you can contribute on both of these accounts, regardless of your employer provides the retirement account or not. Alright, so I will also provide a link in the IRS website where it talks about these details. For example, here if you go to this website, there is this talks about IRA deduction limits, and it gives you more details about the Roth IRAs and traditional IRAs, and it also gives you the page that talks about if you are covered or not covered for 2020 or 2019 plan. All right, so you can check more details over there. So other thing you have to consider is since you are a driver in this account, you should know what you are doing. You need to pay attention regularly, maybe once in 6 months or once in every quarter or every year. You have to make sure your money is growing, and you are your risk. You have to make sure your risk assessment is done, since let's say everybody is different, and if you are not risk adverse, or if you are not a risk-taking guy, your plans might be different than others, so you have to be really careful on that. And the other thing is early withdrawal penalty. If you want to withdraw money from traditional IRA earlier than 59 and a half years old, then you have to pay penalties, and also you have to pay taxes, of course. But if with the Roth IRA, as I said earlier, yeah, you can withdraw the contribution anytime. And yeah, that's the advantage of Roth IRA. So let's say you have contributed 50,000 over the last 10 years and your account has grown up to 150,000. You can always withdraw that amount, your contribution amount, anytime without paying taxes or penalty. So that's really good about Roth IRA. And you can also use that account as a emergency fund, and you don't have to open a separate account for that, and you can better leverage your money and time somewhere else. All right, so let's go to the next slide talk about the 401ks. So what is 401k? 401ks are employer funded, employer provided retirement accounts. So yeah, similar to the IRAs, there are two kinds: a regular 401k, which is tax deductible, and Roth 401k, which is after tax money. The contribution will be after tax money. Similar to traditional IRA, 401k, you have to pay taxes when you retire. In the Roth 401k, you don't have to pay taxes when you retire and you want to withdraw, distribute, take out the distributions from the account. All right, so what is the other difference? The contribution is much higher. The contribution limit per year is 19,500 for 2019. For 2020, I think it might be a little bit up, but yeah, it keeps on changing every few years. So check on the IRS website and make sure you are not over contributing, because I think you have to pay taxes on that. The main advantage of this account is most of the employers, they do either 2 to 6% match on your contribution, so that is easy growth of your money. Let's say you are contributing 2,000 per month and your employer matches 2,000, then you are almost doubling your money instantly. And there is one other limitation of the employer match, but I'll talk about that later down in the slides. And one other disadvantage of this account is you can always you can invest the money, but there is there is only limited options. You can always you can always invest on the employer selected mutual funds. You cannot invest on the individual stocks or companies that you like. The other thing to consider is it can be rollover to rollover IRA after employment ends. Alright, so there are other limitations, which are selected investment in instruments. As I said earlier, you can always just contribute on the employer selected mutual funds. There are early withdrawal penalty. If you want to withdraw money, you have to pay penalty fees and also taxes. Employer match is vested after one or 2 years or few years. Thing is, okay, let's say your employer matches 100% up to your 2 or 6% of your contribution. Sometimes it is not vested, so you have to wait 1 year or 2 years to be employed with the employer to be able to get the money vested. So that is also one of the disadvantages. But overall, it has more goods than bad. So it's always good to invest on 401ks whenever there is the employer is matching to your contribution. All right, let me show you a brokerage account where you can see all these accounts. Let's say in here If you can go to Fidelity, and if you go to the investment products, you can go to retirement and IRAs, and you can see these accounts available here: Roth IRA, traditional IRA, and rollover IRA. And this is what I talked about earlier, where you can roll over your old 401ks. And also there is also option where you can roll over your 401k to your new employer 401k as well. But I always recommend the rolling over to your rollover IRA if you know how to invest and how to grow your money. All right, so let's get back to slides. The other thing I want to talk about is health saving account, HSA. A lot of people are confused this account with the FSA, which is called flexible saving account, and which is use it or lose it by end of the year. So this is not the case, guys. So one other thing is, to enroll in health saving account, you have to be enrolled on the high deductible insurance plan. So that is really important. And the thing is, money will stay in your account even after the year ends, and you can always invest this money as well. I'll talk about that a little bit later. So what is the contribution limit? 7,100 per family, 3,550 per individual. So it is tax free, not even FICA taxes. You don't have to pay Social Security tax or Medicare taxes as well. So that's a lot of saving in there. So can be invested into mutual funds, but yeah, similar to 401ks, it has limitations of employer choose mutual funds. So other thing is, you can also roll over, similar to 401k, you can roll over to HSA provider of your choice after your employment ends, and that HSA provider might be offering the individual stocks investment. So it is a good idea to roll over to HSA provider after if you leave your old employer. So main advantage is you can use the money for all the medical expenses tax free, meaning you don't have to pay any income taxes or FICA taxes on all these expenses. So that is really good, and it helps you save some money there. So I'll always recommend all the people to have HSA accounts. So that's really helpful. You can also grow your money if you don't have medical expenses for the year or a few years. So other thing is, you can also treat this account as a retirement account, because we all know most of our medical expenses occurs during the old age when we retire, and this account can be really big if you are contributing regularly until you are retiring, and it can also grow with your investment instruments, and this can also be used for non-medical expenses after the age of 65. So that's really important. After age of 65, you can use this money as for the non-medical expenses though, and I think you have to pay taxes on this if you are using for non-medical expenses. But however, since you have not paid any federal taxes or FICA taxes at all, so this is this has grown tax free for maybe set number of years, and it is similar to the other traditional IRAs that I talked about earlier. So just keep doing that, and you'll be good for the retirement. All right. So I know, this is my first video, and there is limitation there. I think there might be some something I missed, and maybe you had some more questions about some items that I discussed. Please write down in the comment below, and I will try to reply to that, and I will try to address in next video. And please subscribe. I'll be making more investing videos in this account. I'll also be teaching you how to invest. All right. Until then, see you.